Welcome to the Real Estate and Wealth Podcast, your go-to resource for navigating the world of real estate investing and wealth creation. This podcast is brought to you by Calvert Home Mortgage Investment Corporation, your trusted, caring, and responsive short-term mortgage lender in Alberta and Ontario. We explore strategic and tactical solutions to elevate your real estate portfolio, drawing insights from seasoned Canadian investors and trusted advisors. In each episode, we dive into various aspects of real estate investing, including market trends, property analysis, financing strategies, risk management, and much more. Whether you're a seasoned real estate investor looking to expand your portfolio or a beginner taking those first steps, this podcast is for you.
Hey, everybody. Jesse Bobrowski and Rob Maver here, hosting today's Real Estate and Wealth. We got some really cool guests that we've been fortunate enough to work with and support our clients through. Gentlemen, why don't you introduce yourselves?
Yeah, Ehren Laycock, one of the founding partners and obviously co-owner of BLD Financial, along with my other business partner here.
Yeah, Josh Findlay, partner. Erin and I have been doing this for about 5 years now. We've been helping investors scale, develop, purchase, figure out new creative ways to be able to purchase real estate and navigate different markets. And those paths brought us to the great relationship we actually have with Calvert today.
Awesome.
I think it's actually one of my favorite startings to a relationship because when you first called us
5 years ago
in a car ride to go shoot videos, we thought you had no idea what you were talking about because you called us and told us people could buy properties with $20,000 down, and we're like, this guy doesn't know the difference between 20,000 and 20%.
We kept correcting him.
Yeah, you're like, you mean 20%, and you're like, no, 20,000, and then it blossomed into a great relationship. But
I think we've we got to be over 100 million between the two of you and your agents.
I think so.
We're well over 100 million. So that confusion between 20K and 20%, a lot of fruit happened from that.
Those were great times though.
Yeah, it was,
quotations around it. It was a pretty crazy market when stuff like, when those burrs and flips were getting done. It was pretty wild.
It was the best of times. It was the most of interesting times. But a lot has changed since. BLD Financial, tell us about what's going on with BLD and that rebrand.
Yeah, I mean, it's exciting. Erin and I are excited about it. So for anybody who knows us previous to this, we owned the Findlay mortgage team together and we've rebranded into BLD Financial. So we've seen a massive shift from where real estate investors were transacting, 3 or 4 or 5 years ago to where the investment is going now. And it's fundamentally shifting to multifamily real estate. But as policies change, red tape is getting cut, capital is being deployed in different places like the Canadian mortgage bond. Investors have to become more sophisticated now to be able to really get into making money in the market. It's just the affordability isn't there anymore on residential real estate. So
right.
Erin and I saw that, and we've shifted to creating a firm that's going to help focus on the mid-level investor developer. We're pretty jacked about it.
Yeah, I mean, for us, it just, BLD, like the abbreviation BLD, just kind of really embodies more so like what we're seeing and what we're doing more transaction wise. Buildings encompasses everything, like a lot of 3 to 4 unit guys, they're still on the smaller residential side, still trying to build up, their portfolio there. Single family homes obviously don't make a lot of sense anymore these days with where mortgage rates are at and prices and where rent's at. So, still seeing some of the smaller multis, but then a lot of the investors that built their portfolio up over, the couple of the hot years that just tapped out on either their personal side or their portfolio side, made the switch over into the multifamily, the commercial, that 5 unit up. And then that opens up kind of a whole new, avenue of financing and, land and development. We're seeing a lot of that stuff right now, especially with the zoning changes that are kind of hitting all the cities across Canada, allowing up to 4 units. So, a lot of infill, small level development. And then obviously just, some of the bigger guys as well too, the developers are needing assistance as well, just trying to figure out how can I make my projects work. Maybe some of the developers that were doing, condo sales are switching to purpose-built rentals, and they're just not familiar with the financing options and how it works. So we're kind of seeing everyone across the board, just kind of looking for some solutions and just some guidance on that. So yeah, we feel that it embodies like what we're doing a lot more right now and gives us a nice firm feel as well with it. So
So you guys are a boutique brokerage looking to service real estate investors, specifically those who are looking ahead at what's down the pike for opportunity, and that appears to be mid-level and more land and development type of financing.
Yeah, construction, land, development. If you understand fundamentally how debt is placed within Canada, the big players in the space, they only like playing over a certain dollar amount. So like
Right.
big guys, you're like $10 million. And then you have different types of capital requirements. So the banks can only give you what they can give you. So
Right.
Erin and I realized pretty quickly that if you can be an expert in different types of capital and different types of strategies, we have a leg up on the banks because the banks can't advise you on how to buy an underperforming building or the best strategy to be able to buy it and then stabilize it and then turn it into conventional CMHC debt.
Right.
Like there's a gap in the market, and that gap is growing, and we see that the need for our services it's exponentially going to grow as the average investor continues to grow. I mean, one of the pillars of our business has always been teaching people.
Right.
Like we create YouTube videos. We've taught Canada essentially how to invest in different strategies. That's how we came to
I
meet.
found you guys originally is just understanding who was in the market in Ontario that really truly understood real estate investing for that. Let's call it the non-institutional, right? In which today, like you stated, would be that 10 million and under. And it's so underserved as it relates to trusted advisors that are in that business and know what they're doing and can advise their clients on financing and other. And that's where you guys have built your business and brand.
Yeah, I mean, that service level almost gets, everyone has their own relationship working with the big banks in terms of how the service is. And, some guys hate TD, some guys love TD. I mean, it all depends on who you talk to. But I mean, there is that overall sense where that personal level service just isn't there coming from the banks. And it does get a little bit almost even worse when you get into the larger commercial stuff, just because the dollar values are larger, right? I mean, you try to go to BMO or TD and try to get an apartment building done. And unless you're 15 million, 20 million, especially on the construction side, they don't even want to look at it, right? And so that's like Josh said, like when we first got into it, noticed there was a huge gap there. And even on some of the smaller like mortgage investment companies, the mix and stuff like that, there's still 10 million on construction. And even on just financing, purchases, refinances, some of these guys don't want to touch stuff under 5 million. Where if you take a look at the highest percentage of volume of transactions that are being done right now are in that, sub $10 million construction area. So, the majority of the guys doing the transactions right now aren't falling into a place where these big banks, these big commercial guys really want to spend the time and spend the manpower doing it, because for them, it's the same amount of time to do a $2 million deal as it does a $20 million deal. And for them, it's
right. Where's the juice?
Exactly.
The bigger
right?
deal.
And when you get, further into like CMHC, and we can touch on that, but when you got bonds and you got to preserve how much capital is being put together,
right?
You'd rather save that money and put that towards your big developers who have less risk than giving that to a new developer. So that's where we noticed it was underserved, and that's kind of where we jumped in, and we kind of made that our niche, and we've had a lot of success helping guys grow, coming out of the res side, getting in the commercial side, getting in the development side. Because anyone who wants to kind of move from that res investor into the multifamily investor into the developer, you have to build that CV along the way. And
yes,
it involves using a lot of private financing to get you there, because the big guys want to see the experience, and until you have that, you just can't quite get there on a lot of files. So you kind of have to start in that semi-private area and just kind of build your way up.
So let's talk about mid-level though. I understand what it is. You guys understand what it is. For our listeners, if you had to define, what does that mid-level real estate investor look like today? Is it dollar volume for the mortgage or dollar size? Is it property type? You guys have built a niche and a moat around that business. What is that? So our listener can understand exactly what that is.
Yeah, I mean, I'd say like 8 million and below on transaction amount would be something that would be mid. The person who's maybe purchased a 12plex or 24plex, 30plex, and they've done like one or two, like they're not quite at the point where your experience level is the bank wants to work with you. You still want to work with them. It's like an inflection point. Once you do enough, the bank wants your business, but until then, it's just not there.
Yeah.
So 8 million and below, that real estate investor who's transitioning from still an awesome real estate investor, but somebody who's just huge net worth, many, many doors, 8 million and below.
Yeah, and you got to get to that net worth is the problem. As Ehren said, you have to get the CV. You have to have the experience. The chicken for the egg the whole way up until you can get to the top. And then once you're there, the banks want to work with you. So our job specifically is to make sure we can move you from where you're at to becoming that bigger investor. We want to scale. We want to help you grow. We want to give you the high level institutional advising that you deserve, you don't have access to.
Right.
And that's really the goal, is just institutional level investing strategies for the mid-level investor.
So a lot of it is real estate investors who have a plan and a vision to grow their business through investing in real estate, and that's where you guys play.
Yeah, I mean, I hope they have, like a pretty sound vision and goals. Sometimes we have conversations with guys where, they'll say, hey, like, take a look at my portfolio. I'm kind of bleeding. Like, can you help me? Like, what should we do? And maybe not so much on the multifamily side, because most multifamily has to be cash flowing to get your financing. But guys that are looking to maybe transition into there don't always have a specific goal, because they're kind of asking, should I sell? Should I do this? And then you start asking questions like, do you want cash flow? Do you want equity? And sometimes they don't really know. So I'd say, like, taking a quick step back, like, before you make that jump, like, really definitely have those goals and that game plan dialed in, and like, what are you looking for? But I'd say, like, I've talked to some guys too that have, high net worth, $60 to $100 million. And real estate's an interesting thing where, because you have so many professional advisors helping you along the way, you can get to a net worth of 100 million without really understanding real estate and all the products and all the things, right? You have your realtor,
especially in a hot market.
Yeah, especially
like
especially
you can get there
market.
accidentally,
Yeah.
Which I think a lot have in Ontario, without being amazing operators.
Yeah.
Because they've rode which was essentially from, let's call it 2020 through to 21, a really good wave of appreciation.
Yeah.
Even going back further before that.
2 decades.
Yeah, it was 2 decades of constant
2000,
appreciation. Yeah. We didn't really observe any type of major price correction. And then, of course, March 22 happened. And then I remember driving in my car in July of that year with a 100 BIP increase. And it felt like a shot to the chest for investors, thinking, oh boy, here we go. Yeah, like, 2+ decades really made a lot of people right.
Yeah.
A lot of wealth was created.
So you can find yourself accidentally there. And then it's, how do I deal with this net worth? How do I do stuff? And some of these guys, like, the issue is there's that automatic assumption of, well, I'm worth 60 million. I should be able to get this financing, right? And it's, you got to just kind of bring them down a little bit and say, hey, look, like, this is how it works, right? And it's great that you have this net worth, but when you take a look at it, a lot of it's tied up in equity, right? I mean, especially if you have land, that land value could be 30-40% off depending on who do you go and talk to, right? I got a $50 million piece of land. Well, it could maybe $25 million if you talk to this guy. It could be 30 if you talk to this guy. It could be 60 if you talk to this guy, right? So, like, there's just so many things that kind of go into the financing side. It's not necessarily just about the equity. It's the building and how much of that is liquid, right? You could be worth $100 million. If you have zero liquidity, you can't do anything. You don't have any down payment. You don't have any cash flow to be able to service your debt. Like, how are you going to make it work, right? So there's kind of so many things that go into it. And that's where Josh and I kind of step in, is just, hey, we're going to show you how it works and what do you have to focus on and how do you, what steps you have to take to be able to grow and actually be, successful in that growth and not just have a nice looking number on paper.
Yeah, so you'll provide, like, the advice, the ideas for them to operationalize and professionalize that portfolio.
Well, there's so many steps involved in it, and guys who are operating at this level, nobody has one project.
Yeah.
You got like 4 or 3. You're juggling all these balls around. You're trying, if you're looking to make money in Ontario, you're buying something that's underperforming or needs capital to be able to deal with it. The bank isn't doing that. You're trying to juggle your debt servicing in your portfolio while trying to get these projects done, while trying to get conventional financing done. Like, you have to have somebody who oversees all of it, from all the way from your structure on how you have it structured to where your capital is being allocated, how you're going to go about structuring it, when it's done, moving money around. Like, it's a lot more complicated than just going to a bank and saying, like, I need this one deal done, because if you got a guy who's going to tell you what you can do in your next step, but that next step is going to put you 4 steps behind, like, you're in no better position. So, we obviously see that as a glaring issue or hole in the market that we're trying to grow.
And looking at it holistically.
Yeah.
Not just,
On
I
a
need
transaction.
this deal for this reason on this project. No, we need to do it all. And I guess in Ontario that is, for the first time in a long time, really critical, because we're not seeing appreciation. We're not seeing cash flow like we used to. So I guess for the listeners here in Ontario that may have a portfolio and haven't taken these steps, might be time to reach out.
Yeah. And going back, I think it was your question just in terms of like what do we see in the average investor?
Yeah.
A lot of them are using, private funds to help get the projects done. And there's not necessarily anything wrong with that, having JV capital, having private funds come in. But it's how well do you understand the pathway of your project and the pathway to success to be able to actually, accurately give your investors a proper timeline, right?
Right.
Like understanding what does this look like in terms of how likely are you going to get all your capital back within 12 months? If you're an investor and you're giving your capital to someone and they're telling you we'll have the project done and you'll be paid out in 12 months, that's probably not a realistic timeline in today's market given where the rates are and the appreciation. 2 years ago, maybe when the property would just appreciate 30% like month over month, and you could just do that and you could refinance it, right? You can't do that anymore.
The change the lock flip. Those are the days.
Exactly, right?
Maybe wipe the counter.
In today's in today's market, multifamily and construction has to go into CMHC. There's
Right.
really no other option for it, or else you're leaving all that equity in there that they need back out. And CMHC, especially right now after all these changes that just went through with MLI Select, we're probably somewhere back between 5 or 6 months from start to finish to funding. If it's a new construction,
from application to approval to cash in the bank.
Probably 5 to 6. It could be quicker, but they had a few thousand applications submitted in over 10 days, right? So, and I mean, we've seen CMHC in the past, 2023 when they put out the rate premiums,
Right.
they had 6,000 applications over a course of like 3 weeks, and application, start to finish timelines there were 8, 9, 10 months for some of these files. So,
Wow.
we expect there to be a little bit of an increase. We know CMHC has more underwriters that they've hired over the last 6 months. Should be a little bit quicker, but, just understanding how does CMHC look at things, taking a look at construction financing. They're not giving you a loan based off your loan to value within 12 months. They're giving you a loan on your loan to cost. So when you take a look at your loan versus your as completed value, there's going to be equity in there. If you're assuming you're going to get 95% loan to value and that's what you've told your investors, you're not getting that out right away. So it's just
Right.
understanding, how to protect your relationships with your investors as well too. Because if you're an investor that relies on private investors to give you capital, and you kind of start burning those relationships, so now you're not really moving forward at all, and now you're kind of in a hole. So we kind of help with that as well too, and just make sure that everything is kind of making sense, and not just necessarily your numbers, but are you giving the right expectations to the people in your team as well.
The level of sophistication for an investor has drastically increased since we've gone through the rate increase cycle.
The necessary to be
requirements,
sophisticated.
yeah.
It was a culling.
Yeah.
That's kind of the analogy that I used.
For sure. Like, a lot have shed away, but the ones who want to continue to play the game have to start to understand site plan approval and development, and how does an IR work, and like how do I buy these underperforming buildings, and the intricacies behind the financing. Like, we're starting to find that the level of sophistication for our investors is also having the increase out of necessity.
Yep.
And I mean, as they grow, we grow, and we love it. It's great to see that you're having these high level conversations with investors. But if you're looking to play in the space, I'm not saying you can't go buy a single family home somewhere, but like, we're finding that a lot of investors are either forced teaching themselves, or we're finding that we're helping guiding them a little bit more than we used to.
Yeah. But even to the buying a single family home, which is where Calvert participates mostly, because of the today lack of appreciation and the monetary environment where it's tighter to cash flow, it is critical that you have a certain level of sophistication. Like, it's the speculators have been pushed out of the market.
But they play a valuable component of the market, I would say, too.
Yep.
Because if you don't get a certain amount of pre-sales, new developments don't even get built. So, but a lot of those people have been pushed to the sidelines.
I think the market definitely kind of, like, in terms of those that are playing in it, kind of keeps itself corrected, right? You got the guys that are new to real estate. They hop in during a time like 2020 to 2021, and they make their money on it, and then they get caught up in the pre-sale, the pre-con hype, then they get stuck holding on to 15, pre-cons, and they're like, I'm screwed. How do I make
The
this work?
invisible hand giveth and the invisible hand taketh away.
I think it definitely, unfortunately, weeds out individuals. And I mean, it's a good thing and it's a bad thing. Obviously, no one wishes, someone to have to go through that sort of financial hardship and potential bankruptcies and stuff like that. Cause it's a big thing to have to go through, obviously. But, real estate at the end of the day it's still a really risky investment, right? It still is an investment. It's very similar to like playing in the stock market. It's something that you can do your own kind of forced appreciation to. It has its own cycles. And I think people that got burned and still want to stick in, and people that are feeling the pain are starting to learn the cycles and understanding like, okay, like where are we at now? The market moves in these like, somewhere between like 7 to 8 type cycles. And, we're at the top now where rates are what should be at their highest moving forwards, and things should be coming back down, and then starting to understand how does that impact cap rates and how does that impact my project values moving forward. And, I think that's where we see a lot of potential success in the mid-sized development right now, where if you can make the projects work on these higher interest rates and you can carry it out for the next 7, 8 years, 10 years,
right?
As these rates come down and these cap rates come down, you're going to have a huge increase in your project value. And that's going to give you the ability to sell or refinance it down the road and make that there. And with it being multifamily, again, it has to cash flow for you to get a loan, whether you're, even if you're with CMHC and you're absolutely maxing out the debt service at 1.1, add your insurance premium in there, you're 1.05 based off of CMHC expenses. Even if you're just breaking even or just making a little bit above that, you're still in a good position.
Right.
So I think that's where the majority of guys are going to go, and that's kind of what we see. But you have to learn from the market, right? Like you have to be able to learn the cycles and how things work and how the interest rates correlated, or else you're never going to grow, and you're always just going to leave yourself open to getting burned again.
Yeah. That learning and that work, I think, is a critical piece. Like real estate investing is investing and it's work. And if you're not willing to put in the time and effort to understand what you're doing and why you're doing it, and challenging assumptions and comparables and pricing, then you're leaving yourself exposed to advisors. You're leaving yourself exposed to the market, and like any job or investment, the successful ones are going to be the ones that are doing the work.
Yeah.
The people that you love working with are the ones that have done all their homework. They know their numbers inside and out. And I think, unfortunately, for a long time, because of a really hot market, that wasn't happening. But we get back to the invisible hand. But again, like the clients that we love working with, the clients that you guys love working with, are those, regardless of where they're in their net worth or their door or their journey. You could tell quickly the ones that are in it for the right reasons and are doing the work and understand what they're doing. So I think that's a really important distinction. We moved quickly into a bit of CMHC, MLI, lots of terminology that I'm sure some of our listeners will know, but others won't. So let's set the stage to get into this CMHC and MLI conversation, because you guys are experts at that. And I think it's important that our listeners get to hear about that expertise. But basically, in terms of a more macro trend of real estate investing in Canada, regardless of all these intricacies, Canada is significantly undersupplied as it relates to housing. And that supply issue is likely to persist for a very long time. The federal government's trying to say we can get this affordability. So the supply issue is then leading into this affordability issue. There's just not enough houses for people that want houses, which has driven our prices up. So I believe, for the first time since this was happening 10 years ago, but for some reason our policymakers and our leaders weren't being serious about it.
Well, immigration wasn't where it was at 10 years ago.
Right.
We didn't physically see the problem 10 years ago.
Right.
Not a problem, but we didn't physically see like the housing problem.
Yeah, million people a year, like almost. Like it depends on what numbers you're looking at. Like,
you're starting to really feel it. You have these conversations with people now. It's like people, like everybody, like one of the top things other than food costs is shelter costs. It's a conversation piece now. It's not something that was ever really brought up before.
It's top of mind for most Canadians, and it's absolutely top of mind for our policymakers, both from a federal perspective, a provincial perspective, and a municipal perspective. And watching those macro trends is how you can become educated and successful in terms of where to deploy capital and how to deploy capital. So let's talk about like who is CMHC and what's their purpose, and then we can get into MLI. CMHC.
Yeah, CMHC is Canada Mortgage Housing Corporation. They're a crown corporation. They're an insurance company at the end of the day. They provide mortgage default insurance. So for anybody who's listening who's ever bought a home, like an owner-occupied home, but less than 20% down, it's the same company. They have an insurance premium if you put less than 20% down. Now they have this for commercial finance. Now the difference between commercial and residential, there's multiple different options in the country. There's Sagen, there's Canada Guarantee, and there's CMHC. The commercial side doesn't have that. CMHC has a monopoly on the commercial side of things. Now, CMHC on the commercial side, anything above 5 units, you can get CMHC financing for. They have a minimum loan amount of roughly $1 million, depending on the lender you go to. And they will essentially finance any project across the country as long as it meets the minimum guidelines. Really, the advantage of CMHC is lower debt servicing coverage ratios. For anybody who doesn't know that, this is how you qualify for a mortgage with commercial financing. They take a look at how much net operating income there is in a building and how much it can support. And for every essentially dollar it's costing you, you're making 10 cents on that dollar. CMHC with one of their products, that's their classification. Whereas if you went to a regular bank, you'd be like 1.2, maybe 1.3, depending on the asset class. They also allow for much higher loan to value options, so up to 95% loan to value. And they also allow for up to 50-year amortizations on some of their products. So, when it comes to a higher interest rate environment, the reason why we're even talking about this is because it came out of necessity. It came out of the need for people to either bail their projects out, get construction financing done. Like, I think it's really hard to comprehend how much money was moving at the time when interest rates went up. And my personal opinion, I think CMHC single-handedly kept the Canadian economy going. Without CMHC, I think it would be in a very serious financial situation.
Yeah, so this Crown Corp insurer is basically Coles Notes version of what you said, is taking on different risks than anybody else is in the market.
Yeah.
And by doing so, promoting entrepreneurial activity in real estate, which as a result is promoting building, which as a result is creating supply. And
it also has extremely favorable rates.
Yeah.
The rates, like that's the main driver. Is it's based off the Canadian mortgage bond instead of like the regular bond markets. So you're looking at a rate differential of almost 3%, which is massive when you're looking at qualifying.
And it's also allowing these entrepreneurs to be more successful.
Yeah.
To be more successful because it helps with that cash flow piece.
Successful and also just saving projects too. I mean, like it's, like where, the debate can be, where do you draw the line of someone who's successful and someone who's just kind of towing the line and kind of getting their project saved. At the end of the day, I guess it just depends as to whether or not you end up bankrupt or not. I mean, you can kind of keep making your way across, and if you just kind of keep scrimping it through, you're a successful investor. But like in my opinion, there's a majority of the files, or a high amount of files going into CMHC right now that in a more normalized like rate market wouldn't be CMHC files. Like, should a $1.5 million fiveplex be in CMHC? Probably not. Like if you take a look at where rates were 2 years ago, 2022, we were underwriting, credit union commercial rates at like 3.5%, 3% debt. And then, 9 months later, we were at, 6%. And then another like 6 months later, we were there. So I mean, like it's really made it almost impossible to be able to get these projects. And not necessarily impossible, but given the leverage and given how people are investing in real estate these days with borrowing a lot of that private equity to get it done, is what's making it impossible, because they have to get all that equity out to be able to pay back their investors and make them whole. If, for someone who has capital and is okay leaving 30% in, 35% in for now, and then maybe make it up when the market changes, you can still take advantage of these uninsured products. And there's a lot of guys out there who don't want to work with CMHC and don't like the process, don't want to have to lock it in for 10 years.
And there's hoops to jump through.
Insurance premiums. Like there's guys that just they'd rather put their money in, leave the equity in there, and they're fine with the equity, and there's a huge cash flow, and they're fine with that.
And
But
most of those would be really well capitalized.
those are like your old school investor guys
Right.
that they're used to playing that old school, have to put the money in type game to make it work.
Right.
And that's that. And there's those guys, and then there's the more new age investors where it's leverage and debt. It's go out there, get your prominent money, put it to work, get the turnaround time, get the uplift, pay them back, make your, get your experience up, get your equity out, take your piece, and then just go and repeat it. And you have a bit of a cash flowing asset. And again, there's nothing specifically wrong with that until it does start to go wrong. And when it starts to go wrong is when you just don't have the right information and education on how everything works. And are you feasibly in the right position, and is this feasibly the right project for you to be able to take on private debt?
And now, so going back to like your focus is that mid-market investor. We talked about the difference of like the guys that are getting started without a massive balance sheet. This is almost a necessity now.
In today's current rate environment, as an exit strategy, I would say yes. I think that success to an investor who's in the middle range requires their capital back. And to get your capital back, CMHC is the most viable option to do that at the end of your project.
Right.
In today's rate environment.
So today's rate environment has existed now. When did rates peak? Last
2 years ago, a year and a half ago.
Okay. So over that period of time, what is your percentage of working with CMHC versus not over that period versus previous ballpark percentages?
Right. I mean, for my deals, I'd say like 98% of the multifamily has to go into CMHC for that specific investor to be able to make that project work for whatever.
So that's the investor that's gonna do the work and hold.
Yeah, refinance it, get their capital back, and hold.
Right. And then what was it prior to?
20% maybe.
Yeah.
Like numbers
What a
work.
shift.
Well, it's because like there's an insurance premium. Like it's like a legitimate cost to taking on this debt, and it's a lot. It's like depending on the product you take, $66,000 of every $1 million if you're looking for the standard option, and if you have like 100 points, you're like $33,000 on every $1 million. Average deal is $2 million. You're $100,000 in insurance premium just to get your money back. Like people weren't doing it because they didn't have to do it. Like it's really a set it and forget it option for a larger investor to keep a legacy asset that's stabilized and leave it alone.
Right.
But people are using it as a tool now to be able to access the capital to be able to continue to move on. Again, that mid-level investor, like capital is their lifeblood. They need to continue to move it to be able to grow, and accessing capital is the most paramount part of a project. So if it's stuck there, you can't get it back. You're not moving.
You're done.
Yeah.
Well, plus everything was penciling, 24 plus months ago. We were in that deeply negative rate environment. So if you couldn't cash flow then what were you doing? You're playing the wrong sport.
Yeah.
And is it, just so I'm clear and our listeners, like when we talk CMHC for real estate investors, is it always the MLI Select Program?
I'd say MLI, again, like just given, having an extra 10% in equity return, like they would rather have that 95% potential loan to value.
What is MLI?
MLI is just like, all it is like MLI Select is Mortgage Loan Insurance Select Program. Like the MLI program was the old energy efficiency rebate program that was just repackaged into, instead of it being a rebate on the back end, it was front loaded. So you get your points ahead of time and you would save right from the get-go. Whereas like prior, you would, build out your project, get the energy rebate, then apply for it, and then they would rebate something back on the back end. Now it's all front loaded. So there's your CMHC standard, which has no point system. It's just straight qualifying debt servicing. And then there's your MLI, your Mortgage Loan Insurance Select Program, which takes a look at a point-based system on pillars of energy efficiency, affordability, and accessibility. Within each pillar, there's a scoring point, and then overall, there's a scoring system of 50, 70, and 100 points, which dictates how to get your financing. So your 50 points is, up to 85% loan to value with a 40-year AM. Your 70 points is a 95% loan to value, 45-year AM, and then your 100 points is your 95 and 50-year amortizations.
So energy efficiency,
Accessibility and affordability.
Yeah.
Accessibility and affordability.
And so CMHC, what we were talking about previously, just about like all those applications going in, they changed their rules a few weeks ago.
Yeah, because they saw that, and I want to get into that because we for a long time as a private lender, for the multifamily, we would fund, let's call it, I like to use the word of a underutilized property that has significant deferred maintenance. The investor is going to come in. There's a lot of there. It's mostly all vacant. The investor comes in, adds value through renovations, rents it out, and then CMHC or MLI would refinance us. But that CMHC always had a rule in place where they don't refinance non-NHA lender. And then they started actually enforcing that, which curbed that behavior. And I thought it was so unfortunate because these are loans that the banks aren't doing. These are loans that that doesn't make sense to do a CMHC loan at the front end. So let the investor come in and get it to where it's habitable and then go CMHC. And we were seeing investors be really successful at that, but then they curbed that. And I think the new rules, they paid attention to that activity and they've helped with that. So what are the new rules? What's changed?
Yeah, a few major things changed. One being the NHA requirements. So as you said previously, you weren't able to pay out private debt. Anybody that wasn't NHA approved, which is National Housing Association.
Yeah.
There are only really a handful of mortgage investment corporations and private capital firms that have this designation. So it very much pigeonholed who you could acquire underperforming buildings with if you wanted to move into CMHC directly after your project. And as you said, it was extremely restrictive. Like, it doesn't allow people or investors to buy these underperforming buildings. And so what they did was they changed that. Now we can pay out any sort of private lender. Doesn't need to be NHA approved, which is a big win for real estate investors in general. You can pay out VTBs now. So anybody who's looking to acquire these properties, vendor take-back mortgages are phenomenal ways to acquire assets. And I think that was one of the smartest moves CMHC's done in a while. It's going to allow investors to take these assets off of legacy owners. A lot of these owners have multiple of these things and they have no mortgages on them. They've owned them forever. So, if you can buy at tomorrow's price today, but you can get a mortgage from them at a really great rate, it allows you to be able to go in and not have to pay the fees or, pay absorbent burn rate on this project. So big change there.
And I'll just, for 1 second, a lot of these legacy clients, what we see is they're not operating them effectively. They have significant vacancies. They have significant deferred maintenance. And in turn, this is exasperating supply issue. So by having, let's call them the sharper investors, get in and really want to or need to operationalize and professionalize these buildings and fully utilize them, rent them, that's helping
massively.
I think there's a few things that go into that specifically. I mean, I think, again, like just talking about old school investors where they are more used to having to put a larger amount of equity down and keeping that equity position larger than what we're working with today. I think you take a look at interest rates and the cost per door back, I don't know, go back to like 1980 or however far back you want to go back to when investors were buying the last like 50 years. They might have been okay with these lower rents because you take a look at these guys now and they've owned a building for 10, 20 years. They don't have a mortgage on it, or they got like 10% like loan to value. Like the mortgage is so low that, I got some legacy tenants paying $600. I don't care. I'm still making money because I got no mortgage on it. For them, again, having been that more equity position type investor, they were able to weather that a little bit. And over time, like it's okay. And it makes sense for them and they're able to carry that. But in today's market, it doesn't work to have a legacy tenant paying $600. And then, you can take the conversation even further in terms of like, what does that do to a rental market where you have guys that won't leave because they're paying, 25% of today's market rate. And then you create these, you create a broken system. And I mean, there's more pieces to it, but when people won't leave, then you got to start paying people. I mean, specifically the people who won't leave, you force that building owner to have to make up that rent by slightly increasing that rent, and rent slightly increases. And then over time, rent just has to go up. Cause I think, another conversation too, but I think the biggest misconception and the holistic picture of real estate is the misunderstanding of, a tenant in terms of why is rent increasing, and, from a landlord's perspective and a builder's perspective of like, well, I qualify on my income. Like I can't build you new rental units I don't have the amount of rent to qualify for my mortgage. Like I have to be making a certain amount of income to qualify for. And from a tenant's perspective, for those that aren't in the know, I think they look at it as these guys are being greedy. They're trying to make money, like whatever it is, right? And it's not necessarily like that. Obviously, there are individuals in real estate to make wealth, but again, there are a lot of guys that are there to help build up the community and really do care about providing quality rental units. And those guys aren't there to just take advantage of individuals. This is how the process works. It's no different than someone trying to apply for your car. You have to have an amount of money to get your loan, right? Like for a landlord to be able to build you your rental building, he has to have this much income. And when you have these issues with rents and guys not paying in a rental market, specifically like Ontario, it makes it very challenging. And then you started to run into these high rent issues. And that's what happens when you have, a controlled rental market. And you take a look at like you guys out here in Saskatchewan and I think some of the places out east, like New Brunswick and that, where it's a bit more easier to negotiate the rents and kind of less enforcement. You don't have that same rental inflation.
Well, the LTB restricts increases to a certain percentage on every single year.
We're talking specifically Ontario right now.
We're talking specifically Ontario right now, where rental increases can only be a certain percentage year over year. So that's why you see, market rent for a bachelor could be $1,750. Have a tenant in there paying $600. What that does is it actually kind of forces that tenant to stay in there, even though they might not be the best. They might not be the best tenant for that space anymore. So you have people withholding rental inventory from an area that desperate from a market that really needs it. And then it also restricts the landlord from being able to earn the rent that they need to, because property taxes go up, insurance goes up, cost capital changes. So people have this image in their head of, oh, it's a profit seeking landlord. Well, if we just exchange the word profit with efficiency, because the former drives the latter. So it can be a really challenging environment for landlords.
It's even more difficult when you don't have government help either, right? Like you look at new builds right now and, costs are up, rates are up. I mean, I guess costs are actually technically kind of down right now, maybe 5 to 10%, at least in the GTA area. I think I saw a stat. But, development charges are up another 40%. Like you take a look at like DC charges over the last, Daniel Foch had a stat. It was up like 2,000% or something like that over the last 10 years. Like development charges are up multiple thousands of percentages. And,
right.
You take a look at 33% of the cost on a new build, like go to the government.
Yeah.
I did, I understand the government's got to make their profit and that's, they got to be able to do something like that. But, if you were more efficient and you had this red tape cut and it didn't take you 6 to 12 months to get permits in the GTA or approvals in the GTA, and you could turn around and you could do it in 2 to 3 months, I don't think we would have as big of a conversation around the cost of this stuff getting done and 33% of it going to the government if things were getting done properly. If they're actually using those expenses and that income to make the system quicker, hiring people, make it more efficient, faster turnaround times, I don't think people would have as big of a problem. Obviously, it's still going to be a conversation point, but it's the same as just paying government like taxes, right? I mean, if my taxes are going to things that are going to make it a better country, I'm okay with it. And I think the government wants to be justifying their increases in expenses and fees, like do something about the system, make it more efficient. We keep talking about how bad we're hurting for new units, rentals, and for new ownership units. But there's nothing that's being done from the government side to actually really facilitate this to be any faster.
So we're not seeing anything. Like I was going to get. Let's now start to talk about. So we talked a lot about current state.
Yeah.
What trends are we seeing? Like certainly we're talking about it. We've seen CMHC make changes to, I'll call it, make it more. Increase entrepreneurial activity into solving this supply problem. And we hear our provinces talk about it. We hear our municipalities talk about it. We've seen some stuff done here in Alberta from a provincial and municipal standpoint as related to zoning and as related to promises to make approval processes quicker and cut red tape. But like, what are you guys seeing with your investors right now with what's currently happening and trends that are coming on board that's worth paying attention to, and that you guys believe is going to be areas where people should be investing into?
Well, it was Build 23, like to build homes faster, where your SPA and approval process is supposed to be cut.
Okay.
For 10 units and under, you don't have the same parking restrictions, but like talking to some of my clients that are building these like 10 unit buildings in Toronto, I got some guys right now that are looking at building, like 8 side by side type 8 unit projects, not being submitted as 16 units, but for under 10, and their permits approvals was supposed to come in November this year, and now they're being told like February, March of next year. So I mean, like I think it's supposed to have cut the red tape a little bit, but it doesn't sound like it's actually getting implemented. And I think the way that they worded it, and I mean, I could be misrepresenting a little bit, but I think they basically, instead of having multiple steps, they turned it into one big step. So it's kind of still the same process. It just feels more streamlined from what I understand. I could be wrong, but I think in terms of are people actually feeling it be expedited, I don't think so. I don't think that feeling of expedition is there for these approvals and permits.
Agreed.
So it's not getting cheaper and easier.
No. It's not getting cheaper or easier.
Really?
It's I mean, a trend though. I mean, it just increased densification overall. Like,
Right.
I think that the municipalities even just allowing 4 units or 5 units on a single building lot without having to go through rezoning is massive.
Which Calgary just went through.
Yeah, you get
Toronto went through it a few years ago.
Yep. And it didn't really catch on until recently. And the fourplex plus ADU construction project in the GTA is massive right now.
It is,
It's huge.
That's good.
Some of the people who are looking to do this, it's specifically viable because you're able to recoup a lot of the cost of the project on the back end with CMHC because it's 5 units. So realistically, if you were to build anything in the GTA, the cost of it, the income on it wouldn't be able to support the massive cost it costs to build because the land value is so much.
Right.
But CMHC, because it's 5 units now, you can have higher leverage, lower debt servicing, higher amortization. You can recoup a lot of that capital back. So longer term play, obviously investors have been banking on it forever, but the cost per square foot in the GTA is going to continue to increase.
Mm-hmm.
And people are banking on the fact that, I'm going to build this thing, wait 10 years. My cost per square foot is going to double, over the next decade. And then I'm going to either condo them all off and sell them off individually as condos, or, restructure the debt later on. But the fourplex plus ADU, buying a double lot, severing it, building 2 side-by-side fourplexes, wrapping it into CMHC, and using a combination of residential construction and then insured financing. Again, like where the client sophistication is going is a massive trend to what is happening in the market. Like we're seeing people look at different steps or different types of debt to be able to become successful. And so a lot of infill construction development, having to find opportunities. The beautiful thing about an investor is they'll make money in up market, down market, sideways market. There's always ways to make money. It's
Totally.
just like they're morphing.
Yeah. We've been doing it for 40 years and we see it in any market. But like for the listeners, that's why I love working. One of the many reasons we love working with the Build Group is like, what is out there? How can we, like, we're here, Calvert Home Mortgage, to be curious and to create solutions. Of course we have a mandate in where we want to lend and what we want to lend on, but like this additional dwelling unit has been an amazing trend for us. Like in Calgary, in Edmonton, we're seeing a ton of stuff where a young couple who's just starting out, and these are not even real estate investors, these are just people who want to own a home, can still get into a bungalow for, in Calgary, call it like your rundown bungalow. Now, not for everybody, but they can get in for $500,000.
Nice.
They can put in $70,000, suite the basement, legal suite, which is something huge, new, and very doable. And then they can go to a build. They can go to their broker, working with their broker, and all the way along. By putting in that 70, they've increased the value of the property, call it by 100. And now they can go to your CMHC, they can go to your lender and say, hey, we're going to qualify at this new value of whatever, 650. And they're going to qualify with the rental income from the basement suite. And now they've built equity for themselves and plus a ton of affordability. And I think that could be a huge trend. Whereas previously you had one family occupying the bungalow, now you have 2 families. You've literally doubled, you've doubled your density.
Well, you take a look at Europe, like if you've ever gone to Europe, nobody has a home.
Yeah,
it's all buildings. It's all high density or mid density stuff. Like that's that's where things are going.
New development in Europe is just taking the roof off and adding more units on top. Like
And I guess that's particularly true for larger centers like Toronto and Vancouver. That's where it needs to go.
Yeah.
But like, your cities with 1 million people where there's tons of land you could build out, you could still do suburbia to an extent, but people still want to live
where the action
near
is.
where the action is, where they work, where they play. And again, to be able to do this with a single family house and now you have 2 families living in it, that in and of itself is material.
Well, it's fundamentally changing how first-time home buyers are buying. If you're going to a condo, you're going to buy your condo, and then you're going to maybe go into a duplex first before you buy your single-family home. You're going to have somebody help you get into that first. Like that mortgage helper has become a massive part of any first-time home buyer who's looking to buy a home.
Whereas now those first-time buyers can go to you and skip 2 steps, buy the single-family house, hack it to an extent, and whether they're considered real estate investors or not, they've just done an amazing real estate investment that will set them up for future success.
It's going to come out of necessity.
The affordability thing, like it's a tough conversation because obviously you feel bad for the first time investors given just where inflation, everything is gone and stuff that's outside their control. But I mean, you take a look at, a family that might be, struggling to buy their dream home and they're making like 150 grand a year or 120, whatever that, typical kind of household income is. But I can guarantee you we've had investors that have made less than a household income combined, but are at 3 or 4 properties now because they've taken a much larger risk. And it's not that everyone should take that risk, but they've gone out, they bought a dilapidated property with private financing, borrowed some money, converted it to a duplex, refinanced it out, took out some equity and had a cash flowing property and then went and did that. Like, I think we probably have guys that are making $60,000, $75,000 by themselves that own 3 or 4 properties. And, they're not big mega homes. There's maybe secondary markets, stuff like Chatham,
St.
people might, St. Thomas,
You're going to get your 1% rule in those markets. You're not getting those in the big urban centers.
So they're getting creative.
Like there are ways
with
to do
trusted
it.
experts that know how to get creative.
Yeah. It's unfortunate that you have to tell someone like, hey, look, if you want to get into this, like you're going to have to take a larger risk or consider taking a larger risk. But the art, like,
that's the nature of any business.
I can't buy a home because
you want to scale. You're going to take risks.
Yeah,
the free days are over.
It's what any business has to do. And are those risks calculated? Are those risks being vetted? Are those risks being supported? Like it's like any type of business activity. To grow, you're going to have to take on unique risks.
Yeah, like. It is doable, and again, it's not conventional. It's not the way people want to get into a house and doing it. But, when you have an investor that makes less than a household and they have 3 properties and, you got 2 individuals struggling to buy a home, you got to change your mindset a little. You got to look at it from a little bit different, understand, it's not like it was. It's not like you're just going to get out of school, get your job, go buy a home, and then you're good to go. Like you're going to have to find a different way now to get into it. And it's going to be house hacking your way through it and finally getting into, maybe it's a condo for your first owner occupied and you ride that out a little bit. And then maybe then you get a semi-detached or like a townhome or something like that. It's not going to be like, hey, I want a detached home with a backyard and a nice big front yard. And, that's you got to kind of shift your idea as like what is a reasonable purchase coming out of the gate.
And certainly that's not for everyone.
No, it's so much more debt.
What percentage of the population is entrepreneurial that's going to want to do this?
Yeah.
But they're out there and we're talking to them right now.
It's doable.
We all 4 of us are fortunate enough to work with these people every day. But it's doable with work.
Yeah.
It's doable with taking on risk. But the work is the mitigating the risk component.
Yeah.
We've talked for a while.
Yeah, we have.
What haven't we talked about before we shut this thing down?
I think our favorite thing about you guys is how many conversations we've had where you guys have approached us and said like, hey, what kind of products do you guys need to see like in the market? Like, is there anything that we can put together and try to come out with a new product? And it doesn't always work. The majority of the time, it probably doesn't always work.
Yeah.
We've sat down and we've looked at stuff and said, hey, this is where we see pain points. Like, is there something that you guys can do? And obviously you guys as a MIC, you have your shareholders and stuff that you have to kind of appease and keep stuff in there. So there's guidelines, but there's not very many other lenders that truly, they ask, hey, like, what's going on in the market. But, we've probably sat down with you guys 3 or 4 times and actually tried to put together like a product. And, you guys are always trying to find, ways to be able to bring more value to the market as well too, where, not a lot of other lenders are really offering that.
I think it comes from a lending institution that has become ultra successful at a niche thing, though. Like I don't know too many private lenders who are as successful as you guys at the one thing you do. You don't really have any competition. So like I could see why you're hunting for a niche thing to be good at it, because your risk is there, your capital's there.
Yeah.
The understanding behind the thing you need to do, whether it's the person borrowing the money, the work that needs to be done, like
you guys have money right now.
you're situated.
Like there's some lenders out there that don't have money.
Yeah,
Well, and
so if you guys are looking
it's
for
the
flips,
fortunate position we put
yeah,
ourselves
money.
in because of managing the risk. Like absolutely, we're in the business of risk.
Jesse promised me he would actually always have money.
And our responsibility is to manage that risk.
Yeah.
But even on those conversations, like what is so great about them is whether they go somewhere or not, we're challenging each other and like, give me the why. Like I'm never going to say no without the why, I hope. And if I ever do,
Let them know.
you guys can call me on it.
Yeah.
And
we probably already know what to know if that's the conversation. Yeah. It's
but certainly this ADU thing is something on our radar, something we know with our mandate of providing affordable housing to as many people as possible. We need to figure this out. And also with this change in MLI Select Program, it's another thing we need to figure out. We don't want to play in the larger stuff, but man, the guys that are doing those 10, 12, 20 unit buildings, we know there's a way that we can support in a unique fashion that will bring value to the market. So thank you for those conversations.
Yeah.
No, thank you for supporting us. Yeah, I know we're really excited to continue to push Build to new limits, and obviously with you guys as support, like we always know that you guys are there for us, and we're looking to grow and help our clients and push and grow as the average investor grows, as the Canadian economy grows. You hear what's happening with the federal government. They're screaming about new housing and development and financing it. We've never been in a better situation than right now in history. I mean,
We're in the business of.
Well, that's it.
Let's fix this.
That's it. You have investors licking their chops at the idea that one day maybe you can get permits quickly. Like it's an insane thought. But if the doors truly open up, I think you are going to see an opportunity like you've never seen before. I think it's going to make 2020 and 2021 look like a joke.
Yeah.
If they can truly open up and figure out how to allow people to construct and build, maybe they'll axe the tax and cut the red tape. We'll see.
Yeah, like I'm particularly interested if we have a change in federal leadership, what happens there. They're saying all the right things in terms of being favorable to business, but we haven't seen a platform yet.
No.
Maybe this is
election
a challenge.
talk is election
This
talk.
is a challenge
This
to
is
the
who we're not.
conservatives to
This
give
is
us
not
something.
what we are.
Like,
But like, I love what you said probably about 20 or so minutes ago, where it was, there's a lot of opportunity in this market, or the more sophisticated investors are digging in right now. My mind went towards, well, building and redeveloping is capital intensive. Permitting takes a while. There's a lot of challenging obstacles to manage right now. But what opportunities on the other side of that? So when the cost of capital changes, what kind of equity could people realize in 5-10 years if they build and succeed in this current environment?
But those who are going to find a way to make it work are going to find a way to make it work, right? And then those who want to just, be a squeaky wheel and complain about things not being affordable and not do anything about it, they're always going to have that population of person, right? They're not going to find a way to make more money. They're not going to find a way to
There's no such thing as problems, only opportunities.
Right. So, it depends on the type of person you want to be. If you want to find a way to get into a house, you can find a way to get into a property.
We just talked about it.
Yeah.
We just talked about it. You can
it's
easily
doable.
get in.
The risk is there,
Yeah.
and it's going to be uncomfortable for your first one. And you might, be scared kind of shitless, if we can swear on the podcast. But it's, there's people out there that know what they're doing and how to advise you properly to make it as feasible and as successful as possible. It's just, take the risk if you want to. You can make it work. It's definitely there.
Agreed.
I think that's a good place to wrap it up.
We're not missing anything. Last chance.
I don't think so.
Yeah, when we can always call the guys.
We'll do another one of these for sure.
Follow up.
How do people get a hold of you guys? How do they find out about what you guys are doing, the new shop?
Sure. Yeah, we got a new website, bldfinancial.ca. Come check us out there. Our Ehren and I's email addresses and phone numbers are going to be in the description below.
That wraps up another episode of the Real Estate and Wealth Podcast. Be sure to hit that like button, share with fellow real estate enthusiasts, and subscribe to stay in the loop on all upcoming episodes. Get in touch with the team at Calvert Home Mortgage Investment Corporation by calling them at 1-888-752-4642 or email admin@chmic.ca. The opinions expressed in each episode belong to the individuals featured and do not represent the views of Calvert Home Mortgage. While we provide valuable insights, consulting with qualified professionals ensures that your unique financial circumstances are carefully considered, aligning your investments with your long-term objectives. Calvert Home Mortgage Investment Corporation is not a financial advisor, and we cannot advise you on making investments. There are risks to investing in real estate and the potential that you can lose all of your investment.